Let's talk about more on the Fed and the markets and your money with David Zervos of Jefferies. He's chief strategist, and Alli McCartney, managing director of U.S. Private Wealth Management, UBS. Alli, start with you, because you promised when you sat down, you said, Brian, I've got some historical context and stats. What'd you bring?
Okay, here we go. So you just had a guest on that was talking about the tenuousness of capex and the investment that has to happen in this transformational catalyst. If we look back at everything from the steam engine to telecom to electrification of the grid, for an extended period of time, so over years, not over months, somewhere between 2 and 5% of GDP was spent on infrastructure to keep those things going. Right now, we're at about a year, maybe 2, of slightly less than 1% being spent. So when you think about the context of where capex is a bubble, all of that sort of relevant information, I think if we believe, and we were talking about this in the break, that we are making history and transforming and catalyzing something very new, scary and very new, that there is more to go, both in terms of capex and upside.
I love this view, because a week and a half ago, I was on Route 80 right here. Took Route 80, which is right here by CNBC. I flew across the country on an aeroplane. I landed and I got back on Route 80 outside of San Francisco. And I thought somebody somewhere made the decision, we're going to build highways across this country. We're going to spend a ton of money building asphalt into farmland. Is that kind of, David, what we're doing right now?
Up in the sky, I think it is what we're doing. I mean, we're creating, the network of the future. We're creating a technological advance that seems to be moving forward, I think, even differently than what happened in the 1990s. I think Jay Powell last week said a lot of things I didn't agree with, but one thing he did say that I agreed with was that this is different than the 90s. These companies are making money, Brian. They have significant revenues. The concept is proven, and now it's a matter of scale and investment. And I think we are going to see, we have a very high probability of seeing a transformational AI trade, transformational tech trade that has with it a lot of creative destruction. And I think that's going to be the real issue for the policy.
I agree. And I was at the NASDAQ in the late 90s. A lot of those companies were garbage. And we found that out. That's not my opinion. We found that out. The stocks went to zero. They realized there was no man behind the curtain cranking the wheel and making the thing. You referenced the Federal Reserve earlier. You might have heard me sort of quickly ask Steve Leishman, how does AI and all this money factor into Fed's thinking? It's got to influence them somehow.
You would hope it would, but I don't think it is. I think with the new Fed folks that will be coming in next year, it will probably play more of a factor, Brian. You've got more supply-side thinking rather than traditional Keynesian demand-side thinking. And that should have folks looking at it more like a Greenspan would have looked at it in the 90s, where he pushed back on the staff and he said, you know what? Yes, growth is strong, but we don't need to hike because growth is strong, because these are supply-side driven.
He also said irrational exuberance in 1996. The market briefly wobbled, and it turns out it was like the wrongest thing ever said.
Yeah.
I mean, now 4 years later, he was right. But in Wall Street, that's wrong. If you're 4 months early, you're maybe 4 years early, you're totally wrong. But a lot of stocks keep going down, Alli. Like a lot of the consumer stocks are lower. It just feels like everything is about these same 10 stocks.
I like that you brought that up, because I think it feeds off of what David was saying. This is a K-shaped economy when we talk about that, right? So the fact that we've had governments since the financial crisis dumping money and leaning into risk, and the rich have been getting richer and richer, and we have a technology, AI, that is likely going to disempower lower level employees, right? So you're hearing a lot about
That's scary, what you just said.
It is.
Scary.
It's very scary.
Rich are getting richer. Middle-class workers are more and more afraid of their jobs or losing their jobs. And younger people feel not hopeless, but that they can't participate in the American dream.
The unemployment rate in young people right now is very high. And so I think that the Fed not only has to think about the technological advancement and the quantity of money that's going into infrastructure build, but they really have to start to think about the labor market and unemployment differently, because there are so many structural things in the labor market that are changing, whether it's due to immigration, AI, aging population.